Hello, hi everyone. I am Shekhar from Factor Lab and welcome to the monthly review of the month of February. So the last month has gone in a very constructive mode in terms of the earnings season. So we have seen almost all the companies having posted a very good earnings season, and that's what we've been looking for in terms of the Q3 results. The Q3 is October, November, December of 2025. And if you see the stats out of the 500 companies, top 500 companies which are listed in India, almost 51% of these companies posted more than 15% year on year increase in profits. That is a record 8-quarter record high. So in the last 2-3 years, we haven't seen such a healthy growth in profits across the board. And what is more interesting is that the top line, the revenue has grown up by 10% on an average across all these 500 companies, and the bottom line, that is the profits, have grown up by close to 12 to 13% on an average across all these 500 companies. Now, if you remember in my last monthly review, I was talking about how the Indian companies are best in terms of the profit margins. They already clock a very good profit margins just after the US, and the only thing that is left for us is to push the R&D or to increase the net revenue, and we have seen a good revenue increase also in this quarter. That is something to note. Now I'll give you statistics of further breaking down the large, mid and small caps of how did the profit margins improve across these three sectors. The large caps on an average have improved their profit margins by 10% year on year, whereas the mid caps have improved by 16% year on year their profit margins, and the small caps have increased by 32%. So the profit margins of small caps have grown tremendously well. Now you see a very good earnings season coming back into our Indian corporates thanks to various efforts, our low interest rates, healthy fiscal policy, and supported by the GST rationalization and other initiatives of the government and in general about the economy as well. Now we are in a good shape in terms of the earnings. Now let's see what is happening with respect to the stock markets. Are they moving in a similar way as the profit margins have improved, or are they faltering down? So let me share my screen and present the stock prices as well as the index prices over the last 1 month. Now let me show what has happened with respect to the prices over the last 1 month. Now the last 1 month has been pretty bad across equity. So the earnings, whatever improvement that has happened, were actually not being seen in the prices. The large cap, mid cap, small cap, across the board there has been correction except for the junior 50 where it has had a small uptick. And even if you see in terms of the factors also, most of the factors had gone down. The worst affected factor was quality, which fell down by 4%, followed by low vol, which fell down by 3.5%, and then followed by value 2%, whereas momentum fell only by 1.5%. And if you see at a macro level, it is across the board. In the Hong Kong has seen a correction of 1%, Nasdaq by 3%, Nifty by 4%, and silver and gold obviously are an exception when the markets are having tough times and there's a war-like situation. These are the safer asset classes. Mind you, there was a deep correction even within the month of February within gold and silver. Even though after the correction, still the month-on-month improvement in gold and silver are these numbers. Look at the kind of volatility that one must have experienced in these asset classes. Now if you look at the sectors, the sector that is notably done worst in the last 1 month is Nifty IT. In the 1 month alone, it has fell by 20%, and followed by realty, it again fell by 13% in the last 1 month. And I think both have a very high correlation because of the IT sector usually booms the realty sector, all the salaried employees, the purchase, the real estate or the flats or the apartments, and that obviously is seen as a hit. And even the FMCG and consumption also took a massive hit of 7.5% in the last 1 month. Now the sectors that did really well are metals, the PSU banks. Metals have gone up by 20% in the last 1 month, whereas the PSU banks have gone up by 17%. And notably, the CPSE or the public sector enterprises also have gone up by 12.5%. This is broadly what has happened at the sectoral level. Now I wanted to also show you a couple of two sectors which I'm also tracking, and they're looking really good, and they are let me just open up my trading view. The two sectors that I really like are pharma and healthcare. If you notice, the pharma and healthcare, without any noise, they have slowly been correcting and then consolidating and then reaching the all-time highs. This is healthcare and this is pharma's chart. Both are at the near all-time highs. You might be seeing a lot of talk or action about PSU banks and metals where they are doing really well, right? And there are proven ones because they've already been doing really well, and they've already hit all-time highs, and they've already been in the continuous rally. But these two look phenomenally well shaped for the next leg of up move. So I'll show the ones that have already done well, which is PSU banks and then Nifty metals. Apart from metals, even commodities also has done well. I'll show the metals and commodities chart. This is commodities. Commodities is also at the all-time highs, and let's see the metals chart. Metals chart is also making fresh highs. So if you see where is strength, where should one take position, that is clearly PSU banks and metals. And if you ask what are the next bets, then they are healthcare and pharma. And if you see what are the extreme worst case scenarios where one can take contra bets, that is IT. But even I would still refrain from IT because it doesn't look like the bottom is here in terms of IT, and so it is too early call as a contra bet. So that is broadly about the markets. If you have to summarize, we have done extraordinarily well in the earnings, but that earnings haven't translated into the price. It is not because of any other reason. It is because the markets are forward looking, and they are already baking in the efforts or baking in the news results about the war and considering a discount. Now let us also see what are the valuations of the Indian markets. Where are we placed at? That also throws up some interesting insights. Now let us look at where the valuations are in the Indian market. Now we are seeing a good earning season and decrease in price. So what does it usually mean? It means that the valuations are slowly cooling down and giving good entry opportunities for long-term investors to accumulate the stocks in the Indian market. Now if you look at the CAPE ratio, which is CAPE ratio, as I repeatedly say, is a better metric to track than pure PE ratio. CAPE ratio is cyclically adjusted PE ratio. Cyclically adjusted meaning it takes the 10-year inflation rate and discounts the PE ratio. So you actually are making an apple to apple comparison of PE ratios across time frame. So meaning, let's say you are comparing a PE ratio of 1998 or 1999, and say then you're saying the PE ratio of 2026, and some might say that, hey, back then India might not be that richly valued, now we are richly valued, or someone might not have even think that our economy would grow this bigger, so they might have given a very low values back then. Now we know that there is a lot of growth potential, and hence the PE ratios might be elevated. This is the new normal. So how do you account for these changes in PE? So the only way to account is to do the inflation adjusted and then normalize the PE ratio. That is what CAPE ratio is all about. Now CAPE ratio, if you actually plot across the larger index, that gives you an even more better metric of how the overall valuations in the Indian markets are. So I'm going to show you the CAPE ratios of BSE Sensex and then Nifty 500 CAPE ratio. I would in fact more track or more lean on Nifty 500 because it is a much larger index than BSE Sensex. It is only the 30 stocks, the top 30 stocks of the BSE Sensex. Now if I look at the monthly CAPE ratio of Nifty 500, the orange colored line is the current CAPE ratio, and right now obviously we are, if you see, the mean is at the levels of 26 and 27, and right now we are at more than 1 standard deviation away from the mean value. Now while that is too bad in terms of the valuation point of view, but if you actually see with respect to its 5-year moving average, we are now close to its 5-year moving average, and we have never touched the 5-year moving average in the last 6 years. The last time we touched was during the COVID crash. So in terms of valuation, there is no better time than now in the last 6 years to purchase these stocks. But again, if we go back and if we see even further, there were times that whenever the CAPE ratio touched the 5-year moving average, it did not quickly bounce back. It did bounce back. It stayed at least for a couple of months to then move up in terms of valuation. So these are ideal points of accumulation in terms of the Indian markets. That is something that one can clearly say. And if you notice the BSE Sensex also, it shows the same thing. We are right now at 1 standard deviation above the average CAPE ratio. But yes, we are touching the 5-year mean value of CAPE ratio. So on the earnings point of view, we are doing good. On the price point of view, we have seen a good correction. And in terms of valuation, the valuations are sobering. So if you look at all these aspects, we are in a good position overall from here on to accumulate and start to take position towards equity. While having said that, does it mean that we need to discount gold and silver in our portfolios? No. Gold and silver always play a very good diversifier or hedge in our equity portfolios. Having a meaningful allocation these two, that is gold and silver, to our portfolio will definitely hedge our overall portfolios and will bring down the volatilities. Now, before I wrap the monthly session, I also want to take a quick look of how our small cases are performing, because we just touched 100 days since launch of our small cases. I would want to show the performance of our 2 small case strategies and then call it a day. So first, let's take a look at our dual momentum quant. So dual momentum quant, as of today, that is 3rd of March 2026, we are up by around 15%, whereas the equity multi-cap is down by 4.5%. See, we have started this strategy on November 20th. So that's the overall performance of our strategy. And if you look at the other small case strategy, which is the adaptive asset allocation, in here we did fairly decent. That is, we did 2% profit or 2% up as compared to where we started back in November 17, 2025, versus the equity multi-cap has fallen by 4.5%. Now, each strategy stands for a different purpose. The dual momentum quant is a high aggressive, high returns kind of a strategy, whereas the adaptive asset allocation is more like a wealth protector, stable, low volatility kind of a strategy, and each are independent in its own nature. With that, thanks a lot for tuning into this monthly webinar. I really appreciate you joining. Thanks a lot. Have a nice day.